In this video I'll be covering the swing trader trading system. I'll be going over this package, covering the back-tested and also the walk-forward results since live trading began on the two algorithms that are contained within this package. Before I do that though, I'd like to go into the risk disclaimer. AlgorithmicTrading.net is what's called a third-party trading system developer. We are not registered commodity trading advisors, so we develop trading systems that are 100% automated and algorithmic for use in the futures market. They can be traded on the TradeStation platform or auto-executed with best efforts by one of the NFA registered brokers. Keep in mind that trading futures does involve substantial risk of loss. Past performance is not indicative of future performance. And also note that in this video we'll be talking about back-tested data, walk forward, and when we say walk forward, we also mean to imply in some cases live trading as well, but it's safe to just assume that all the trading that we're talking about here is from hypothetical accounts. In other words, the model 15K account that we're going to show is assuming that $15,000 was traded on these algorithms back when they were last optimized, and then walked forward to show how those algorithms have done. The algorithms have traded in live accounts throughout that period, but because some of the fills that we show are from the hypothetical TradeStation account, the simulated account, so we have to have that disclaimer. But we will be, I'll try to talk more about that as it comes up, but feel free to pause this slide and read this more carefully. But just keep in mind that trading futures with automated systems it's really not for everyone, so just remember that there's risk involved. No trading system is perfect, and there's no such thing as a holy grail. But we do think that we have a great system here that we'd like to show and kind of highlight some of the good and the bad of it, and I hope that helps. So with that, I'd like to talk about the swing trader algorithm, and to start we'll talk about the momentum ES algo. The momentum algorithm is one of two algorithms that are traded in the swing trader package. To illustrate that, I'd like to go to my TradeStation account and just kind of show you what I mean. So this algorithm on the left is the S&P 500 E-mini futures, and what you see is the swing trade algorithm is applied to this chart, or the momentum ES algorithm is. If I kind of zoom out, you'll kind of see what I mean. And recently we've been in this Trump rally, although the last few days the market has been selling off some. But just to give you an idea of what we're looking at here, this is the S&P 500 starting in kind of November all the way through March of 2017. And what happens is when you code a TradeStation algorithm, it allows you to apply it to the chart, and that's when all these trades populate. So if we kind of zoom in, you'll see a few of the more recent trades we've had. So today is actually Tuesday the 22nd. Yesterday, coming into the weekend, we were long the S&P. So on Friday we were long the S&P, and on Monday morning we had a gap up, and this algorithm got out with a gain, and then it sold off. So the little blue dotted line that you see here is a winning trade. The red dotted line is a losing trade, like we had here. And what you'll see is that this algorithm has actually done really well in the last few months. If I kind of zoom out or go back in time, you'll see kind of the start of the Trump rally, and it's really done well. If we kind of go forward in time, you'll see that there's been a decent number of winning trades. I don't want to go into too much of the details of this algorithm though, because we do cover it in another video, and but really it's just to show you that the swing trader trades two algorithms: the momentum ES, which is this one here, and also the TenYear Note, which is this one here. The TenYear Note algorithm is the one that does well when the market when the S&P goes lower. Typically there's a negative correlation of about negative 35% between the 10-year and the S&P, which means in the long run, on a weekly basis, closing week to closing week, going back since I believe '03, if the S&P is lower, as it was on Monday, then the 10-year note will be higher, as you kind of see in this rally here. Now, they don't always trade inverse to one another, but overall, if you average it all out, that is how they trade. So by trading both these algorithms, we try to take advantage of both up-moving and down-moving markets. The sideways moving markets are always the trickiest to trade, but these two algorithms handle it really well. In particular, the 10-year note will usually do really good in kind of an S&P sideways moving market, and the momentum algorithm just won't trade a lot through those periods. And if we kind of zoom out, you'll kind of see what I mean. As the market was going lower back here in January of 2016, this momentum algorithm was just on the sideline because you don't see any trades throughout here. But let me go back to the foil, and we'll kind of keep talking about this momentum algorithm. So this algorithm began trading live back in October 2015. At that time, we called it the bullfire, but it's the same algorithm as the momentum ES algorithm. We just changed the name. This is an equity curve of the walk forward results, meaning the results that we've seen in the hypothetical account since we last optimized, and that's on a blind walk forward out of sample data set. So what that means is that, not to get bogged down in too many details, but most of you are probably familiar with back tested results and how those are always going to be the most optimistic results that any developer can show. The walk forward is always going to be a little bit more pessimistic, and we rate them based on efficiency. So how efficient is the walk forward compared to the back tested? And in this video, I want to really highlight the walk forward results of this package as opposed to the back testing. And so that's what we're showing right here. So if somebody started back in October 2015 with a 15K account, trading only this momentum algorithm, this one algorithm that's contained within the swing trader, then they would be up about $9,100. The percent profitable is about 76%, and this is the equity curve. So it gives you an idea of some of the ups and downs that it sees, but overall the trend has been higher, so that's good on this equity curve. And we've actually recently been hitting new highs as well on it. So this algorithm has done really well since it went live. And again, this is one algorithm within the package. I can also go back to this chart and show you the TradeStation report. Now this is going to include the back tested along with the walk forward. So what it's doing is looking at the entire back tested data, which is starting back here, going all the way through around in here in October, and then this throughout here is all the walk forward. One thing to note is that we do have over 10% of trades that are out of sample now, and once we hit that mark is when it's a lot easier to make just kind of judgment calls on how good an algorithm is. We can look at the trade list as well though, and you'll see the old name that we had is still in here, but this trade list though is where we get all the trades that I'll show you as well as we keep looking at this system. So again, that's a momentum algorithm. I'd also like to talk about the second algorithm that's in this package though, which is the Treasury Note algorithm. Okay, so the Treasury Note algorithm is actually, I believe it's one of the longest running algorithms we have that we still sell today. It was last optimized back in December 2014, and it was an add-on to the NQ Legacy package at that time. At that time we referred to it as the P2 push-pull, but we've also called it the TY algorithm. You'll see the swing trade TY, but we're right now what we call it is the Treasury TY algo, but it's the same thing. And what this is showing is also the walk forward. So basically from 12/15/14 through 3/22/17, this just shows how well this algorithm is done. And again, this is the second algorithm that's in the swing trader package. A couple things that I want to point out though. So it's had 27 trades since we last optimized it, and it's up about $7,000. We also have the per unit size set to 15K on this. I'd like to note though that this algorithm, the overnight margin requirement to trade the TY is really only about $2,500, and so this is a very I don't want to use the word conservative, but if somebody had 15K, in theory they could have traded 6 contracts. This is showing just 1 contract. So of course, if somebody did that, then the max drawdown would have been too much, and they would have had to add to their account. But that's why we show the 15K. So even though it's 15K here, really only about $2,500 is used per trade with the overnight margin. But its percent profitable has been 70%, and so this algorithm has done really well. Here's the equity curve going back to December, and so this is again walk forward, still hypothetical account, but it is a blind out of sample walk forward data. Now, I think another thing I'd like to do is just show you the chart and talk about the 10-year. So again, the 10-year it's basically the 10-year note, the futures for the 10-year note, and it typically does trade inverse to the S&P. And there are periods when they trade closer together, meaning if the S&P goes higher, the 10-year also goes higher. And there's periods where they could both go lower as well. But normally they trade inverse to one another, and the last couple days is a great example of that. Like I pointed out, I think when we were talking about the momentum algorithm, on Monday we had a big drop on the S&P. I think it was the biggest drop since October, I believe, and it's mainly due to some of the political concerns over, I think, the healthcare vote that's due. But again, I'm a technical trader, not a fundamental trader, so it doesn't really matter to us. But I just want to point out that you had a big drop on the S&P yesterday, and let's just kind of look at what the 10-year note did in that period. So this is what the 10-year note did in that same period. And so when the S&P gapped higher, like it did on Monday, the 10-year actually gapped lower, and then as the S&P sold off, the 10-year went higher. And I want to highlight that because I think it's a pretty crucial thing when we're discussing our trading methodology with AlgorithmicTrading.net, which is to be market direction agnostic, meaning we don't care if the market goes up or down. We definitely prefer it to go up because we love this country and it just is more beneficial to more people. But if the market does go lower, then we want to make sure that we're equally balanced or as close to it as we can be. And so that's where this 10-year note comes into play. So if somebody is trading the swing trader, the entire package that we're talking about, then they would be trading the momentum ES plus the TY. And the idea is that as the market goes higher, the momentum ES does well, and as the market goes lower, then the 10-year note algorithm does well. And so the key in designing a system using this methodology is that you want to do your best to prevent losses in the contrary market moves, meaning if the market, the S&P that is going higher, we want to avoid losses on the 10-year note. Otherwise you might make gains on the ES, but then you just take losses on the 10-year. So the key is really to try to prevent the losses in the contrary market conditions, and that's that's really important, I think, when we're talking about the 10-year, because since December 2014, the S&P has gone higher. It's been on in a pretty strong bull market, especially the last 4 months. But the 10-year is actually up in that period. So the fact that the S&P has gone higher and we're up on the 10-year in that period is really good. I mean, we would be happy if this was just break even, because we would have gains on the S&P side, on the momentum algorithm, this one here, because the market's going higher and the S&P, and this is a long ES or long S&P algorithm, the odds are that we're going to do well in a bull market for sure on the ES algorithm. And if we can also do well on the TY, then it sets us up really well, because in theory, if the S&P goes lower and we go into a bear market, then the 10-year should do even better, and that's our expectation. So I think with that, what I'd like to do now is talk about the combined results of the two algorithms combined, which is the swing trader, and just talk about how it's done. Okay, so now what we're looking at is when we combine the two algorithms together, this is the complete swing trader system. And what you might note is that we start the walk forward on October 2015. The reason why we start in October is because the Treasury started in December 2014, but the ES started in October 2015, so we have to take the largest period to show a consistent walk forward. If we went back to December, then it would be a hybrid of back-tested plus walk forward. So what we've done is we just started with October 2015 through the 22nd of March 2017, and basically just combined those two algorithms. And so this shows you the blind walk forward results of the swing trader package. And so a 15K account would be up about almost $12,000. We've had 148 trades on the ES and the TY combined. Percent profitable is 74%. The max drawdown is about 6,700. And so if you kind of average it out, average gain per month is about 4.5%, and then the average per year is about 52. So overall, this algorithm has done really well in the walk forward. And remember, this is not back tested. This is walk forward. Still on a hypothetical account, so so make sure you consider that disclaimer. And still, past performance is not indicative of future performance, but it does give us an idea of how well this algorithm is done. And what a lot of people ask is, when do you know if an algorithm is still good or bad, or how do you really analyze it? And so now that we have about 10% of out-of-sample data we can look at, then we can start making judgment calls on how well this algorithm has done compared to the back testing. So if I go to this chart, what we're looking at now is the back tested for the swing trader. And so it goes back from October 2003 until 2015. And a few things that we will do to kind of analyze how well it's done is we'll look at things like the slope of the equity curve. We'll compare the slope of this equity curve, the walk forward swing trader, with the back tested equity curve. We'll also look at things like percent profitable. So in the back testing, it was 77% profitable, and in the walk forward, we're at 74%. And that's all within very reasonable expectations. In other words, in my opinion, it's almost impossible to have an algorithm trade as well as it did in the back testing in walk forward once you have at least 10% out of sample. So there's a way that we rate them using an efficiency metric, and it's basically saying how close to the back tested is the walk forward. And the fact that we are so close on the percent profitable is very good. The number of trades is 148. In the back testing, it's 12,444, so we're over 10%. When we hit the 124 trade mark, that was the 10% mark, so we're above that. The average gain per month walk forward is 4.41%. Back tested is 6.3%. So it is down a little bit on the average per month, but still really good numbers. And so overall, we are definitely very pleased with the results of the swing trader algorithm. It's for the most part has lined up very well with the back testing, and so even though again, the past performance does not dictate that it will continue to do that well moving forward, it does at least give us kind of a reference point. So with that, I'll just quickly talk about some of the highlights now that we've talked about the back-tested and also the walk forward. Alright, so as I mentioned, we have more than 10% out of sample, enough trade data to perform an analysis and to really kind of dig into the details and compare how we've done. The average gain per trade, percent profitable, average gain per month, they all match up within reasonable expectations of the back-tested. And a few other things I haven't really mentioned yet, but it trades the TY and the ES futures, and those are I believe those two are the most liquid futures that are traded. And so what that means is that we are not trading, the EMD or the Dow or something that doesn't have a lot of liquidity. We're actually trading the 10-year note and the ES, and the bid-ask on these is always really high. The ES usually is about at least 500 by 500 on the bid-ask. The 10-year is even more, usually 1,000 contracts by 1,000. And so what that means is that with a company like mine that offers these algorithms, is that there's plenty of liquidity to meet the orders that the algorithms generate. It's a 100% automated trading system, meaning it's 100% algorithmic. I do not ever go in and modify any trades on the algorithm. In other words, it's 100% technical. I don't ever say, well, I think the market's going lower, so we're going to modify a trade. And so that's also important. This is 100% automated, and the reason why that's good is it helps remove a big part of the emotions of trading. Anyone that's traded knows the biggest battle that you face is yourself, I guess, to be honest. I mean, you'll run into the case where you might start moving your stops or your limits, or there'll be conflicting technical indicators, and so you don't really know which one is best to follow, so you'll go with your gut, and 9 times out of 10 your gut will be wrong, which is why most day traders fail. So the fact that that the algorithm is making the decisions helps remove some of the emotions. It can be traded on the TradeStation platform. In other words, our customers, some of them prefer to have TradeStation running, and when that happens, we load the algorithms on their platform, just like you see here, and then they let the algorithms run. It can also be auto-executed by one of the NFA registered brokers with best efforts, and so we have a list of brokers that support this system, and you can look them up on the NFA website to make sure that they're okay. And I think those are the main highlights. So with that, I'll quickly go into the correlation analysis between the 10-year note and the S&P. Okay, and the reason why the correlation analysis is important, I think, is because a lot of people might say, and rightly so, they might question some of the walk forward, and they might say things like, well, the market has been going higher, and so everyone's doing well. So I do want to highlight that that half of what's traded in the swing trader package is trading the 10-year note, and the 10-year note does have a negative correlation to the S&P. So so in the analysis that I did, I wrote some code that basically bought the S&P on Monday morning and sold it on Friday, and then also bought the 10-year note on Monday and sold on Friday. And then I basically just ran a correlation analysis between the results on a side-by-side comparison, and the correlation coefficient is negative 35.19%. What this implies is that there's a weak to moderate negative correlation between the 10-year and the ES, the S&P. And so kind of in English, I guess what I'm saying is that on a weekly basis, so if you pull up a weekly chart of the S&P and the 10-year, if the S&P is up, then normally the 10-year will be down. It's not 100%, but that's kind of the normal. That's kind of the standard, though. So there is a negative correlation between the S&P and the 10-year note. which is good for us to know because it helps answer the question that I also have, which is namely, okay, how sure are we that if the market goes into a bear market, which everyone's expecting, how well will this swing trader do? And because there's a negative correlation, we do expect that the 10-year will do well. It's not to say that the momentum algorithm will not take losses. For sure it will. It's not 100%. Here's a loss right here that we took, and here's another one right here. But the point is that the gains from the 10-year, our expectation is that they will offset the losses that we might see on the momentum algorithm. But I also want to do one quick thing and show you how this momentum algorithm did in 2008, which is kind of the last really big bear market that we had. And so what you're looking at here is the results on the momentum algorithm in '08. And the reason why I want to highlight that is namely to show that, and this is back tested though, so keep that in mind, but in 2008 when we were in a bear market, this long S&P algorithm still eked out a gain. And so on a $15,000 account, this algorithm still was up about 10%. Now if I click on the 10-year note chart, it'll show you the results that the 10-year note saw in that same period. And so in 2008, this algorithm backtested was up about 17K, almost 18K. So if you combine those, then the 10-year note was up 18K, and the S&P algorithm, momentum algorithm was up about 1800. So it backtest at least was up about 20,000 on a 15K account in 2008. So I think that mostly covers what I wanted to talk about. Let me see if I have anything else. I guess I don't. So I think the last thing I'd like to comment is just in general the advantages of the swing trader over something like the S&P Crusher, which is another algorithm that we have on the website, and then I'll also comment on the disadvantages. All right, so if you visited our website or if you've been following us, you know that we do offer another package as well. We offer the S&P Crusher and the swing trader. The primary advantage of the swing trader is that we have over 10% of out-of-sample data on it, meaning the algorithms contained within it have traded live the longest of if you compare that to the S&P Crusher. Now the S&P Crusher also trades these two algorithms. So if I was doing a presentation on the S&P Crusher, basically everything I said would apply for the most part because it also trades these two algorithms. The difference though is that the S&P Crusher also trades 5 other algorithms, and so but the disadvantage with the S&P Crusher is that some of those algorithms have only traded live now for about since October of 2016, so about 5 months roughly. So you have the swing trader, which is traded live for well over 18 months, and then you have the S&P Crusher, which if you take the kind of the shortest period of traded live, which would be from the morning gap algorithm, the covered calls, and the iron condor, then we really only have about 5 months of live data on that. The rest is back tested. Now the S&P Crusher recently has been doing really well, where the swing trader has consistently done well throughout that entire period. So if you're torn between the two, we cannot give advice. We're not registered commodity trading advisors. So it's the kind of thing that people have to just kind of decide for themselves. Now, what some people do is they'll trade half on the swing trader and then half on the Crusher. And when they do that, really what they're doing is they're trading kind of double on these two algorithms and then one on the others. But then some people really only care about the walk forward or the live trades, and if that's your preference, then you'd probably consider the swing trader. We've always liked the Crusher because it does trade 7 algorithms, and it trades the iron condor, the covered calls, which do really well in sideways moving markets, and then it also has 3 day trade algorithms. But the bottom line is that the swing trader has consistently done better in the live trades, and so it's not to say that will continue, but so that's really the data that we have to go by. Right now we do have the majority of our customers do trade the crusher, but there are some that trade the swing trader, and so it's really just something that everybody has to decide on their own. You can talk to a registered investment advisor, or since this is futures, a commodity trading advisor would be more appropriate, and they could answer questions unique to your situation. I mainly, my company takes the position that we want to just be as transparent as we can be, and just show the data and let people make decisions on their own. And so I think we've been true to that in showing the data that we have on the swing trader. We'll continue to do the reviews moving forward, showing how the algorithms have done. But the swing trader is just we just can't deny the data. It's done really well. And I think that's all I had. So if you have any questions at all, we would love to answer them. We can do a live demo with you where basically I'll show this screen with you and walk you through trades and give you any updates you want to know. And with that, I think I'll sign off. So give us a call today, and we'd love to do a demo. And just remember, I'll just sign off with the final disclaimer that trading futures and options is not appropriate for all investors. It does involve substantial risk of loss. The max drawdowns that we showed are measured closing trade to closing trade, consecutive trades, so that it's a peak to value but on a closing trade basis. So that's good, and I think that's all. So have a great day, and thank you for watching, and give us a call or shoot us an email and request a demo, and we'd be happy to give you one. Thank you very much. Bye-bye.